Today, banking on the edge. The DFA Daily, the 29th of May, 2020. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Being the last working day of the month, we got the latest credit data for April from both the RBA and APRA. Overall, the RBA reported that private credit was flat over the month, with owner-occupied balances up 0.5%, investment lending down 0.2%, making net housing up 0.2%, and that's reflecting deferred repayments in part. Business was up just 0.1% after a big spike last month, and personal credit dropped 3% over the month. That's a noticeable drop by any standards. Although total credit was flat, the broad money measure rose 2.9% over the month, thanks to the various government and RBA schemes to support the economy, something to bear in mind when we talk about removing the stimulus. Annualised owner-occupied growth was at 5.3%, while investors were down 0.6% over the year, and total housing lending was just 3.1% over the year and a little lower than last month. Personal credit was down 9.3% over the year, and business credit was up 6.7% thanks to last month's spike. APRA showed that total bank lending for mortgages rose 0.19% over the month, with lending balances for owner-occupiers up 0.45% to $1.1 trillion, while investor lending fell again, down 0.27% to $0.64 trillion. Investor lending dropped again to 36.5% of balances. The total mortgage credit was another high at $1.754 trillion. Looking at individual movements, CBA wrote the largest net increase in owner-occupied loans, followed by NAB, ANZ and Macquarie. And Macquarie was streets ahead on investor lending, while NAB, Westpac and the Bank of Queensland saw the biggest falls. ME Bank was back in line this month after the securitisation deal last month. Once again, bear in mind this is as reported to APRA and reflects the net of new loans written, balances extended and loans paid off. And on these numbers, many banks are shedding investment loans quite fast. The question is this by accident or by design? More broadly, the AFR in an opinion piece posed the question why bankers are ignoring the new chill message from ASIC and APRA, saying the regulators have changed their tunes in recent weeks and are now singing off a decidedly different song sheet than they used to in the past. What on earth is going on with the country's top regulators, they ask. Bankers have been left scratching their heads at a sudden switch in messaging from the country's two more important regulators, which is so sharply at odds with the stern pronouncement they were making before the virus hit. This week, the head of the Australian Prudential Regulation Authority, Wayne Byers, urged banks to delay a rush to replenish their capital buffers. He said that the banking regulator had not set a firm timetable for banks that drew down on their capital reserves during the virus pandemic to rebuild their buffers. Banks, he said, should do so as soon as circumstances reasonably allow, but no sooner. And he added, we should not be complacent about the rebuild, but there are also risks from rushing it. Though it makes eminent sense for APRA to remind banks that the whole reason they're forced to hold such large capital buffers is so these reserves can be used during emergencies, it still makes a stark contrast from the banking regulator's previous insistence that Australian banks should be, quote, unquestionably strong. What's more, local bankers have not shown the slightest interest in following Byers' advice and dipping into their capital reserves. National Australia Bank this week announced that it had more than doubled the size of its share purchase plan from $500 million to $1.25 billion, including the $3 billion raised from institutional investors, which took the bank's total capital raising, which was launched in late April, to $4.25 billion. Meanwhile, Westpac and ANZ Bank took a different tack. Faced with a steep jump in provisions due to the deteriorating economy, they preserved their precious capital reserves by scrapping their half-year dividends. As a result, Westpac's Common Equity 1, the CET1 capital ratio, stood at 10.81% in March 2020, while ANZ's was at 10.8%. APRA had previously ruled that the big four banks needed to have CET1 ratios of at least 10.5% to meet the unquestionably strong benchmark. It's not surprising that the bosses of the country's major banks have largely ignored APRA's message. They understand the huge importance of being able to control the timing of capital raisings. NAB boss Ross McEwen told the AFR this week that although he agreed that capital buffers were there to be used, the problem is that if you get down too low, right into the capital buffer, at some point regulators will turn around quite rightly and say, now what are you going to do to get back to 10.5%? Then you've got to work it up at a time when you want to be coming out of the crisis with pace. You end up looking over your shoulder. So I had no intention of this bank being put in that position. But APRA isn't the only regulator changing its message. James Shipton, who chairs the corporate regulator, the Australian Securities and Investment Commission, is now singing a different tune on the contentious subject of responsible lending rules. Because that correct decision will ultimately be a credit one, and that is a credit and commercial decision by the bank, which, of course, is theirs to make, he said. Shipton's comments come even though ASIC has launched an appeal against a responsible lending case it lost against Westpac. The corporate regulator had alleged that Westpac breached responsible lending laws by relying on a household spending benchmark rather than reviewing borrowers' expenses individually. I may eat Wagyu beef every day, washed down with the finest Shiraz, but if I really want my new home, I can make do on much more modest fare, was the memorable declaration in the appeal. That case means that bankers are unlikely to take the slightest notice of ASIC. Their confidence has been shattered by the Hayne Royal Commission. Bank bosses in particular know that if they were to breach standards in any way, they'd be subjected to public humiliation and probably end up losing their jobs. And even if ASIC genuinely intends to give the banks a break on responsible lending, bankers quite rightly question how long the corporate cop will maintain its more easygoing approach. They rightly question whether ASIC will remember its assurances in 18 months' time when the economic recovery is underway. And they're also conscious that loans typically last for many years. So while ASIC might not castigate them for approving the loan in the first place, it's entirely possible that in a couple of years they could find themselves in trouble for the way that they've handled the loan, particularly if the borrower falls behind on repayments later. Among the more intelligent members of the banking community, there's intense speculation as to what has prompted both ASIC and APRA to simultaneously embrace a decidedly more chill approach to regulation. And the consensus is that Canberra has been urging both regulators to do what they can to support lending to business, and particularly to fragile small businesses. The Morrison government is understandably worried that lending to small business will collapse as the virus pandemic sends the economy reeling, and any future economic recovery will be crippled if small businesses are starved of credit. Canberra's concerns are well grounded. Lending to small businesses is always difficult because the quality of financial information is usually poor. What's more, relatively small loan sizes means that it's not economic for the bank to devote time and resources into getting a better picture of the firm's cash flows. And of course, the shock to the economy caused by the virus shutdown means the risks of lending to small businesses are much, much higher than usual. It's likely that resources will be stretched in coping with their existing small business base and restructuring the loans of customers in financial difficulties. It's unlikely that the country's big banks are going to try to write new small business loans aggressively. On top of that, many bankers are working from home, and this is a formidable challenge when it comes to making new loans to small business customers, because face-to-face meetings are so important to bankers in deciding whether to take the risk of backing particular individuals. That's why it's likely business lending, particularly to small business, is likely to contract sharply. despite all the efforts APRA or ASIC are making to convince bankers that they're now taking a more chill approach to their duties. And to that I would add that my small business surveys are showing precisely this, that small businesses are finding it harder and harder to get any finance, even as their cash flow is compressed. I think this is going to be the new centre of gravity of the crisis ahead. And perhaps the members of the Council of Financial Regulators actually do not agree on how to manage the current crisis. APRA's chair, Wayne Byers, has dismissed the need for a cut in the buffer rate for mortgage serviceability assessments, despite openness to an adjustment from Reserve Bank Governor Philip Lowe. Appearing before the Senate Select Committee to discuss the Reserve Bank of Australia's response to the crisis, Governor Philip Lowe reiterated that the cash rate would remain unchanged for the foreseeable future. I have trouble seeing inflation at 2 to 3% for quite some time. It's going to be a long, drawn-out process until we get full employment, which means we're going to keep interest rates where they are, perhaps for years, he said. In light of his concession, Mr. Lowe was asked to assess the suitability of the Australian Prudential Regulatory Authority's 2.5% buffer rate for mortgage serviceability assessments. In response, Mr. Lowe said he did not expect movement in the cash rate to narrow the gap between current interest rates and the buffer rate set by APRA. I think that's very, very unlikely, he said. Something extraordinary would have to happen for interest rates to go up 10 times in the next couple of years. The RBA governor added that given the low interest rate environment and economic turbulence from the crisis, it would be reasonable to consider an adjustment to APRA's buffer rate. APRA did last year make some adjustments to the way the buffer was calculated. It used to be a fixed level, and then it became a margin over the cash rate, which I think is sensible, he said. I think it's a reasonable discussion to have about whether the buffer could be narrowed given the extraordinary circumstances that we're in at the moment. However, in his appearance before the committee, APRA Chair Wayne Byers dismissed the need for the change, stating that the provision also guards against non-interest-based serviceability risks. The thing about that buffer is that if you regard that as simply covering interest rate risk, it's a large buffer, he said. But within the bank's serviceability calculations, it provides a proxy for all sorts of uncertainty. It provides a proxy for uncertainty about reductions in income, unemployment, illness, divorce, and all of those things that happen when banks are granting loans for 20 to 30 years. And Mr. Byers warned that changes to the buffer rate would need to be compensated with alternative measures to mitigate growing credit quality risks. The way we look at it is standards across the system are okay at present. It's a highly competitive market for housing credit. There are hundreds of businesses jostling to provide housing finance, he said. Housing debt in the household sector is already very high, so access to credit and access to significant amounts of credit hasn't been a constraint. We are in this environment at present where property prices could well soften, debt is very high, and income growth is likely to be subdued, if not falling, for many households. And he added, my point would be we need to be very careful about any change, and if you change that buffer purely on the basis of interest rates, you have to make some compensating changes elsewhere to keep standards at a sensible level. The APRA chair also claimed that lenders could incur unnecessary costs associated with alternative serviceability requirements imposed in response to a cut to the buffer rate. My starting proposition will be that there will be a lot of costs and administration associated with changing that, which you wouldn't want to put the system through at this point. And when asked why a lower buffer rate would not be sufficient on its own, Mr. Byers said such a scenario could be examined, but stressed that an easing of credit standards would risk upsetting the current balance in the midst of an economic crisis. I think we'd be very careful in this environment of saying we should be loosening credit standards at a time when significant household debt already exists, income growth is subdued, and for many households, income uncertainty has increased, and we'd want to maintain a degree of caution, he said. My observation would be it is not the case that access to credit is a particular problem at present, access to housing credit. The APRA chair concluded the interest rate buffer only serves to, in a sense, limit the maximum amount a customer can borrow. Many customers don't go to their maximum amount, so it's not necessarily a constraint in lots of cases, but it's a useful controlling system in the environment we're in. And as the ABC reported, the Reserve Bank Governor Phil Lowe said the JobKeeper program may need to be extended if the workforce needs it. He warned Australia's economy would hit a critical point in September when a raft of stimulus measures stops, and it was very important not to withdraw fiscal stimulus too early. The key observation is that the world is very uncertain, and I think it's too early to say what it's going to be, what the economy is going to be in 4 months' time, Dr. Lowe said on Thursday. If we have not come out of the current trough in economic activity, there will be, and there should be, a debate about how the JobKeeper program transitions into something else, whether it's extended for specific industries or somehow tapered. Dr. Lowe was appearing before a federal parliamentary committee via video link. He said the economy may be in a better condition than originally feared, and the RBA had revised down its estimate for working hours lost in May from 20% to 15%. However, he said, even though some jobs in retail and hospitality were coming back as parts of the economy slowly reopened, jobs in industries like construction and professional services are starting to fall away. He said he was glad the 6-month JobKeeper program will be reviewed at the 3-month mark. It's clearly going to be a critical point when that scheme comes to an end, and also when the deferral for 6 months of mortgage payments and other payments that the banks are offering. So that's a crucial point for the economy, Dr. Lowe said. It will be important to review the parameters of that scheme. It may be in 6 months' time we bounce back well and the economy is doing reasonably well, and these schemes, which were temporary in nature, can be withdrawn without problems. But if the economy is not recovered reasonably well by then, as part of that review, we should be looking at perhaps the extension of that scheme or the modification in some way. But I think at this point, it's too hard to say because the outlook remains very uncertain. But it's going to be a very critical point in the economy. And Dr. Lowe said that the RBA support package for the financial system released in March seemed to be performing well. And he also emphasised that interest rates would likely remain at 0.25% for years until the unemployment rate fell back to around 4.5%, which is where the RBA considers full employment to be. Remember, we never got to 4.5% previously, by the way. We're not going to be raising interest rates until full employment is in, and we're sustainably within the 2 to 3% target range for inflation, he said. I think it's reasonable to expect that will not be for some years. However, he also warned that if Australia did not see a recovery fairly soon, the risk of permanent damage to the labour market would rise. And if that occurred, the level at which the economy is assumed to be at full employment could creep back up to 5%. Remember, we were at 5.2% before the crisis. We know from previous sharp economic downturns that there is scarring in the labour market, he said. People fall out of jobs and then have trouble getting back in, and then we have more long-term unemployment. If we don't get a decent recovery fairly soon, we'll see more scarring, which will mean the estimate of full employment starts to rise. But he said the labour market was in a severe state of flux at the moment, and the unemployment rate was not the best indicator of its health. That was because thousands of people are currently working 0 hours, but were still technically considered employed thanks to the JobKeeper program. So a better indicator of the health of the labour force was the number of hours worked by the workforce. On Thursday afternoon, Shadow Treasurer Jim Chalmers said Dr. Lowe's comments highlighted the dangers of the government's snap-back strategy and a rapid withdrawal of fiscal support. A sudden withdrawal of support for the economy in the last week of September makes no sense at all, Mr. Chalmers said. The Morrison government's lack of a plan for the months and years ahead means the downturn will be deeper than necessary, the unemployment queues longer, and the recovery more difficult. On Thursday, new figures showed 72% of businesses now have experienced a decrease in revenue as a result of COVID-19, and roughly the same figure have accessed support measures. And separate ABS data showed private investment was broadly flat in the first 3 months of the year, but firms' expectations of future capital expenditure points to a huge drop in investment over the coming months. Elsewhere, ASIC said that the Federal Court of Australia had declared several terms within 6 small business contracts used by Bendigo and Adelaide Bank to be unfair. The relevant contracts are standard form small business loan contracts which the bank enters into with its customers after the 12th of November 2016. ASIC was also successful in having the Federal Court declare the same terms appearing in other standard form of small business contracts entered into by the bank with its customers in the same time period as unfair. The Bendigo and Adelaide Bank will give an undertaking to the court not to use or rely upon any of the impinged terms in a manner that is unfair or causes any customer suffer damage or loss. Justice Gleeson found that the unfair terms firstly cause a significant imbalance in the parties' rights and obligations under the contract, were not reasonably necessary to protect the legitimate interests of Bendigo and Adelaide Bank, and would cause detriment to the small businesses if the terms were relied on. ASIC's investigation revealed that some of the unfair terms gave the bank broad discretion to unilaterally vary the terms and conditions of the contract without giving the borrower advance notice or an opportunity to exit the contract without penalty. Other terms allowed the bank to take disproportionate actions in response to a breach by the borrower, for example, by calling a default without giving the borrower an opportunity to remedy a breach, or by calling a default based on events that do not present any material risk to the bank. It handed down the judgment on the 28th of May, and Justice Gleeson noted that ASIC, as the statutory authority responsible for enforcing the ASIC Act, has a public interest in seeking these declarations. The court declared that the terms were void from the outset, not from the time of the court's declaration, with the remainder of the contract continuing to bind the parties. The court also ordered that the contracts be varied by replacing the unfair clauses with new fair clauses by the parties following successful negotiations between ASIC and Bendigo and Adelaide Bank. And ASIC Commissioner Sean Hughes said ASIC is committed to protect small business owners of Australia from unfair terms in loan contracts, particularly where business borrowers are confronted with inflexible standard terms. And the judgment shows that ASIC will take the necessary steps to enforce the law. Importantly, insurance firms should be prepared to extend these obligations in insurance contracts, he added. We are pleased the government backed us with additional funding that was earmarked to enforce this area of the law. A new data from the Australian Bureau of Statistics shows that 3 in 4 parents kept their children home from school or childcare due to COVID-19. The 4th Household Impacts of COVID-19 survey found that many of these parents made changes to their work arrangements to care for their children, including working from home at 38%, reducing or changing work hours at 22%, and taking leave from work at 13%. ABS Program Manager for Household Surveys, Michelle Monarch, said women were almost 3 times as likely to stay at home to look after their children on their own than men at 46%, compared with 17%. Parents also reported difficulties experienced by their children when learning from home. These included difficulties concentrating at 58%, feeling lonely 49%, and feelings of anxiety at 33%. And 1 in 7 parents at 15% said a lack of access to a stable internet connection was impeding their children's ability to undertake their schooling from home. The survey also found that 1 in 8 Australian adults at 13% provided unpaid care to a vulnerable person outside their household because of COVID-19, and around 3 in 5 people provided this care on at least a weekly basis at 61%. Family members were the most common recipients of this unpaid care at 80%, and shopping was the most common activity for which assistance was provided, again at 80%. A further 23% of Australian adults said they needed to increase the level of unpaid care for a vulnerable person within their household because of COVID-19. And finally, the lobbying by the housing sector continues, as reported in the Real Estate Conversation. After the Prime Minister announced that his Treasurer and Ministers for Housing are working on a plan to support the residential building sector, the real estate industry of Australia is calling for caution. New home building at record levels has been a crucial support to economic growth over the previous 3 years, said Adrian Kelly, president of the REIA. It stands to reason, then, that in these unprecedented times, government should consider a stimulus to dwelling construction, boosting expected low levels of employment and address growth in the Australian economy. The REAI is concerned that measures which are directed at assisting the purchase of new dwellings in preference to existing dwellings could have a detrimental impact on buyer choice and market activity, and thus lessen the economic impact. Mr. Kelly said that less than 20% of Australian first home buyers preferred to buy new homes. These choices were made on affordability of older dwellings in locations that provide proximity to work, leisure activities, and infrastructure, including public transport, said Mr. Kelly. To limit any insistence of first home buyers to only new dwellings could lead to suboptimal outcomes in the utilisation of existing property and infrastructure. This will come at a time when the proportion of first home buyers is recovering from investor activity in the market. Since 2012, the participation of first home buyers declined until a pickup in 2017. Whilst the participation of first home buyers has improved over the last year, the current level is still well down on the levels 20 years ago, said Mr. Kelly. Subsidising the purchase of only new housing will limit this recovery. Sales of established homes to first home buyers in many cases leads to purchases of new housing by the sellers looking for larger properties that meet their current requirements. In these cases, the multiplier and employment effects are probably greater than when a first home buyer purchases a new house, as the size and cost of construction of dwellings purchased by upgraders is generally more than that of first home buyers. Furthermore, first home buyers of lower valued established homes usually embark on a program of home renovation and improvement, providing a stimulus to the building sector. And Mr. Kelly said a further detrimental impact of limiting assistance to only the purchase of new dwellings is the consequence it has on employment in the real estate sector. Many agents are already reporting a 50% reduction in listings and inquiry levels from prospective sellers, said Mr. Kelly. The indications are that this is unlikely to change for quite some time yet and will result in reduced employment in the sector when JobKeeper ceases. This would exacerbate the impact on agents who have been managing the fallout of tenants losing employment and negotiating outcomes that have kept families housed at the height of the pandemic. REIA therefore urges the government to only implement measures assisting buyers that don't discriminate between the purchase of new and established housing. To do otherwise will have a significant unintended adverse impact. So a couple of points there. Yes, he's definitely right that if you push first-time buyers into new properties, it's going to stimulate the construction sector, but not much else. But of course, he's also making the point and the plea for more transaction activity for the real estate sector. And as you know, my perspective is that we've done the real estate sector to death. The last thing we want to do is to throw more properties into the mix and throw more stimulus, which will only distort the market further. And in fact, Chris Bates and I discussed this whole topic earlier on today, and you can see our separate show, The Latest from the Property Market Frontline. And finally, before I go, a quick reminder that next Tuesday at 8 p.m. Sydney time, we'll be running our next live stream. And that live stream will focus in particular on the whole question of mortgage stress. And we're going to have access to our online database. So if you're interested in finding information out about a particular postcode, you can do so during that particular session. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.